Hi, great. Well, thank you very much. Happy to be here. So I'm going to expand a bit on the cost side that Gerald mentioned earlier. We're going to be looking at order book data, sometimes overlooked by investors, and I'm presenting a couple of metrics that we've been working on. So what are we going to talk about? So I'm going to present myself. We're going to look at just traditional measures of crypto assets liquidity. We're going to look at level 2 data, which is order book. We are then going to look at a sample, just raw order book data, and then I'll present the aggregated order book data that we have come up with. And then we're going to answer that question. I'm an institutional investor, and I have a $500 million order to execute. How do I do that? Where? When? What's the best moments during the day? Is there any arbitrage that I can do here? We're going to look at different markets. We're going to look at different assets. We're going to compare the Bitcoin markets and the Ethereum markets. And then time for questions. So first of all, about myself. So my name is Ambre Soubiran. I am French, studied applied mathematics, and have a background in equity derivatives. I've been a structurer for about 10 years out of London, and I'm now the CEO at Kaiko. So about Kaiko. Kaiko is a digital assets market data provider. We're connected to all the different exchanges around the world where crypto trading happens. We're collecting tick-level data, order book data, normalizing all the data, and then storing it and making it available through our own set of APIs and different file delivery systems. So who do we address? Pretty much every market participants. We're working a lot with crypto funds, hedge funds, quantitative funds, but also with asset managers, custodians, anybody who needs to access a reliable third-party market data for valuation purposes, for trading, for any kind of use cases. And we're also working increasingly with academia. Talking about assets liquidity, the two most common measures that we hear about all the time are market cap. So the market cap is just the number of circulating supply assets multiplied by the latest price. This is often not very relevant in the context of liquidity because we don't know how many tokens are actually in circulation, how many are held, how many are lost. That's definitely an issue in crypto markets. So then we look at daily liquidity. And most of the time, daily liquidity is the 24-hour traded volume, which is number of assets, the total amount, dollar equivalent of assets that have been exchanged across markets. So again, this is interesting, and it gives an idea of how much value has been exchanged between different market participants, but it doesn't really give us a notion of the depth of the market and the structure of the market. So this is what we're going to look at now. I want to expand a bit, not just on using trade data and using executed trades, but using the order book data, which is the volume that has been placed on markets. And we're going to look only at 10% depth order books. The reason for that is looking at the full depth of an order book is not always relevant. So we're trying to take a depth of the order book that is in line with the asset's volatility. And in crypto, 10% seems like a reasonable depth. So using level 2 trade data, market depth. So market depth is really how deep is the market? What is the structure of the market? And how much can it sustain large market orders without too much impacting the price of the security. So it's all open orders, all the buy orders, all the sell orders. We're going to dive a bit more into that. And if we take, as I said earlier, if we look at a depth of order book that is in line with volatility, we get a notion of what volume could actually trade. And then the second thing we're going to look at is price slippage. So the price slippage is when Gerald mentioned that a bit earlier, is the execution cost. So I can find an exchange where the price is theoretically the best. If I want to buy, let's say that it's somewhat cheaper on an exchange versus another exchange. However, depending on the market depth and the structure, I won't be able to execute my 100, 200, or 500K order on that market if the depth is not big enough to absorb my volume. So taking slippage into account is very important when you're trading and also when you're backtesting strategies. And this is an information, when you backtest a strategy on price data, on executed trade data, you completely miss out on that. And it's really important, especially in the crypto market, where volatility and volume hasn't been always very consistent. So those are the two things that we're really going to deep dive into. And the question here, just to kind of center a bit the context, is what do we want to achieve? So I'm placing myself from the position of an investor. I'm an institutional investor, and I have transactions of, let's say, somewhere between 100K and 500K that I want to execute at multiple times throughout the day. So the question is, if I look at different markets, first of all, where do I trade? So I need to look at the different exchanges and understand where can I place my order. As I said earlier, it's not only a question of price, it's a question of slippage, it's a question of execution costs, it's a question of efficiency of the exchange. Then, second question, once I've chosen an exchange, what's going to be my cost? And then, is there any timing pattern? So we're going to look at, across different markets, can I see some times of the day where slippage is consistently lower? So we're looking at that, and we've chosen to look only, for the sake of this presentation, at ETH and Bitcoin. However, all the data that I'm presenting here will be available for all different crypto assets. So selected instruments for the exchanges that we've chosen. We've chosen the following exchanges that are deemed to be part of the exchanges that are very reliable and that have efficient markets. And we're looking at ETH and Bitcoin. We're doing the study over the month of August. Again, I had to select a time period for the sake of this presentation, but the data is available for all history. And the source of that data is Exchange Public APIs, and it's order book snapshots that have been taken every 30 seconds. So I won't spend any time on that, but that's really what we're looking at. US markets, Asian currencies, Singapore dollar, Korean won, and Japanese yen. And then all the different assets versus US dollar. So this, you must be familiar with that, is a snapshot of an order book. So on the left, you have all the bid orders. The first thing in the, where's the laser? Here, you have the timestamp. This is the type of the order. This is the price, and this is the amount. Here, same thing on the ask side. And so if you chart this, you end up with that. And that gives you an idea of what does the order book looks like. What is the current price? Here on the right is what are the main information that you can derive from an order book snapshot. It's best bid, best ask, spread, and mid price. Those are the very, very typical and basic metrics that we get when we look at order books. So if I take this a step further, and I say, OK, but actually, what type of metrics would be interesting to look at, taking that a bit further? So what we've created is a data format that extracts from the order book snapshots the main information. And the main information here are, so the timestamp for each snapshot, the mid price, the spread. That's quite simple and basic. And then we've broken down the bid volume and the ask volume in buckets of 2%. So you can easily, instead of having, when you're playing around with order book data, instead of having that much data, and this is cut quite early on. There's actually much, much more data. This is Bitfinex, Bitcoin dollar, order book snapshot. So the idea is for every snapshot extracting the key information. And then key informations are best bid, are different. What is the actual number of Bitcoins that are placed on the market between 0 and 2% out of the mid price, 0 and 4, 0 and 6, 0 and 8, and 0 and 10, which enables you to create buckets and chart your order book with much less data. And then we've introduced slippage also in the data formats. So the price slippage, we've done that for 3 different order sizes, 100K, 200K, and 500K. And so this will be represented in percentage of the prevailing mid price at time of the snapshot. Same thing on the ask, completely symmetrical in terms of the calculations we're making. But it's actually interesting. We're going to look at the difference between the structure of the markets on the bid and on the ask side. So this is what the aggregated order book data looks like. Instead of having that much data per, instead of having that much data for every snapshot, now we have only one line per snapshot with all the information that I've just presented. So this enables you to chart an entire day in a simple CSV file, or you can just query an entire order book data, market data extracts through the API. And you can get very easily access to all this information. And this enables you also to track what is the evolution of the spread throughout the day, what is the evolution of the slippage, and you can easily chart that, you can easily monitor that, you can put alerts when you want to be notified when the slippage reaches a certain threshold, or things like that. So this represents the aggregated order book data, one per snapshot. So we have a snapshot every 30 seconds. And then what we've done is taken that information and aggregated it at an hourly level. So we just take everything here, and we do averages, and then we get hourly average aggregated order book data. So exactly the same information as earlier, but now we have a timestamp per hour with average metrics. And this makes it even easier to chart and to use and to consume and to monitor also the different data points on a historical basis, because now it's very easy to have an entire year of aggregated order book data in a single file. So that's what it looks like. And now that I've introduced a bit the data, we're going to look at charts and what it actually looks like. So it enables us to do a couple of things. We can visualize the data very easily. The data is all there. It's all normalized, aggregated, and simplified. So order books is a data format that is generally quite cumbersome to handle, and this just simplifies it. We can compute historical averages. We can find correlations and patterns using this data set across different markets. This, again, this is Bitfinex, Bitcoin dollar, and this is the hourly averages from the 1st of August. But you can very easily compare that data to any other exchange data or any other pair. You can compare markets, and you can also compare similar metrics for different assets on a specific exchange. So that's just a historical chart of the Bitcoin dollar order book aggregated data. So that's the 5 buckets that I presented earlier, 0 to 2, 2 to 4, all the way to 10%. And because it's so simplified, it's easier also to use in charting tools. So this is the historical data across a week, the last week of August on Bitfinex, and it gives you an idea of the skew of the order book and the structure and how it moved over time. You can also create hourly price slippage charts. So this is the slippage for different markets, Bitfinex, Bitstamp, Coinbase, Gemini, Itbit, and Kraken. You can see that the lowest slippage during the month of, I didn't put a date. Yeah, it is. During the month of August, the exchange that had the lowest slippage cost was Coinbase, closely followed by Bitfinex, and this kind of enables you to keep track of slippages. And if you do that just on a specific day, you can see when it crosses and when it might make more sense to execute on a different market. So we're going to see a lot of those going forward, so I'll just spend a bit of time explaining this. This is slippage cost. On the bottom line here is the slippage cost for a 100K order, which on Bitfinex, Bitcoin dollar, is around 3 bips. So it's quite efficient, quite low. And here is the slippage cost for a 500K order. And you see the red line is a buy order, and the green line is a sell order. So then on the side, the blurry areas in green are the standard deviation for that specific, those specific lines. What is interesting is also looking at the ratio between a 500K order and a 100K order. We're talking about 5 times the size. Generally, slippage is a ratio of 3 times. And you can also see when there's an order book asymmetry, when it's more efficient to go through buy orders or sell orders. So a couple of interesting things you see here. This is interesting. We found that very completely randomly, but this is Bitflyer price slippage. So shows that the market became much, much, much more efficient somehow during the first week of August. We work with exchanges. They are our supplier of data, so I've actually reached out to them and say, hey, what happened? How come the markets are so much more efficient? This is Bitcoin dollar on Bitflyer. And actually, it turned out that they onboarded multiple market makers for Bitcoin dollar and Bitcoin euro markets. And so the market became more efficient. So it's also interesting to monitor these things and to be aware when there is a significant improvement in the efficiency of a given market, and to know that, hey, actually, I haven't considered this historically because when I looked at it, it was relatively inefficient, but actually it did become more attractive. So that's also interesting to monitor on a real-time basis, or at least on a 30-second basis. the average slippage costs for different markets. So here, we're talking still about a slippage somewhere around 75 bips, which is higher than on some other exchanges, but much, much more efficient over the past month. All right, so here is still the same charts. We're looking at Bitcoin dollar pairs, and we're looking at that on various markets. So you have Bitfinex, Coinbase, Bitflyer, Gemini, Coin, and Kraken. All of those are dollar markets, and that's what it looks like. Here we have Bitfinex, Bitcoin, ETH dollar, and ETH and Bitcoin against dollar and GPY. So the idea here, I wanted to see if on an exchange that trades both ETH and Bitcoin, if there's a difference in slippage, and if you looked at dollar or Japanese yen, if there were also any significant difference. So it actually shows that on Bitfinex at least, the slippage is roughly independent whether you use dollars or you use yens to trade. We're somewhere around, so here Bitcoin dollar, Bitcoin GPY, slippage is somewhere around 5 bips for a 100K order, somewhere around 15 for a 500K order, and then for ETH, it's same thing. So the slippage is roughly the same depending on if you're using dollar or yen. However, the slippage is about double for Ethereum than what it is for Bitcoin. Generally, low slippage is an indication of a very efficient market, and so there's just more volume and more trading activity happening on Bitcoin than there is on Ethereum, at least on Bitfinex. So one of the things, and this I'm sourcing a very good exchange here that was looking at patterns on order book data, and generally the regularity of the slippage and the fact that the standard deviation stays in a specific line is a strength of high liquidity of the exchange and efficiency of the matching engine. So then I was wondering, could we see any pattern in the time of the day? There's crypto markets, as we know, are global 24/7 markets. However, if we take those hourly snapshots and we create a kind of histogram where we're using as bin time of the day, and we chart the hourly slippage, can we find any better time of the day to execute? Okay, markets are open 24/7. However, is there any correlation between where the exchange is based and when slippage is more efficient? I.e., is it more efficient to execute a trade when you're in the US on the Asian markets where people are maybe less active or more active? Turns out, we didn't see, on the most efficient markets, we don't really see any moment of the day where it's more efficient to trade. On the slightly less liquid markets, and this is Bitstamp, ETH dollar, we saw here, and that's really interesting, that from about 8 a.m. to about 4 p.m., slippage cost is significantly reduced, and the standard deviation is also much more compressed. So it seems that on Bitstamp, if you're trading ETH, try to do that during European market opening hours. All right. Yeah. So as we see here, slippage distribution and the standard deviation is more concentrated and so more efficient. However, if we look at bigger markets, more efficient markets where slippage is lower, we realize actually, yeah, if I go back here, slippage here was about 25 bips. And if we go on Coinbase, we see that the slippage is somewhere between 2 and 3 bips for Bitcoin, somewhere between 12 and 14 for Ethereum, and that it's relatively consistent throughout the hours of the day. This study, just a small caveat on this, the study was done during the month of August, so it's only a month of data. Would be interesting to run the same study on a longer time period and see if there's any other patterns that emerge. So no apparent change during the day, and so what we can take away from that is that there's just a more global user base. People are trading throughout the entire day, independently of opening hours of different markets. All right, this is the same thing for Bitfinex. Shows also it's similar execution cost, and it shows that there's really no opportunity in timing throughout the day. And it's also consistent whether we're trading in dollar or in GPY. All right, so this is a very basic chart, but it just shows the correlation between the market depth. So here, what I call market depth, when we talk here about, this is Bitcoin, sorry, I forgot to put a label. So here it's Bitcoin. What I call market depth is when I sum all the volume that has been placed between 0 and 10% on the bid side, and when I sum all the volume placed on the ask side, We're taking all this in absolute value and number of Bitcoins placed on the 10% order book, and that's what I call the market depth. It's also interesting maybe to think of it as the volume that is at stake, as in it's a volume that could trade and that is placed on the market. It's not stored away somewhere. It's on exchange order books. So if we consider that this is what we call market depth, here is the slippage, and I've just charted all the different slippage versus market depth for different markets. This is an average over the entire month of August. We see that there is a negative correlation, which makes sense and goes back to what we were saying earlier. The more efficient the market, the lower the slippage. All right, this is just the chart backing the data that we had just before. All right, I'll leave some time for questions. We have still a few minutes left. And just a few words before we take questions is, so the whole point of this presentation was to show that order book data is sometimes very cumbersome to handle, difficult to use. A whole snapshot is a lot of information. When you just take a snapshot on a market API, on an exchange API, you get its information overload. So what we've tried to do, and Kaiko, as I introduced in the beginning, is a market data provider, and our goal is really to bring infrastructure and to make data as easy as possible to access and as easy as possible to use by pretty much any market participant. So we've came up with this new data product that is summarizing the order book snapshot into actionable insights or things that investors can use to monitor the efficiency of markets. So all the data that I've presented is available through our market API and on a historical basis. And our coverage is on 12,000 crypto asset pairs. So feel free to reach out if you're interested to learn more about it. And just a word, because I'm trying to also hire people. We are just opening a desk in an office in New York. We're going to expand in Asia later during the year. So we're hiring. And yeah, that's it.
All right, Enrico down in front looks very enthusiastic. I love that. Thank you very much. All right, we have a couple of minutes for questions. If we have any questions for the floor, yeah, right down in front here. If I can get the microphone, thank you.
How much does it cost to access all of your data?
It depends on it's a license-based pricing, so it really depends on your use case. If you're a small crypto fund, it's about 2.5K per month, euros. But it really depends on how much usage you do, and it depends also on if you need data only for research, or if you're actively trading on it, or if you want any redistribution rights, this kind of stuff. We also work a lot with academia, so we provide market data on crypto to all the large universities that are carrying out research. We've created data libraries for all top-tier universities in the US, and we were launching a nonprofit as well to help academic research on cryptocurrencies. And this is, of course, for students, almost free.
OK. Any students in the crowd? No. OK. Ladies and gentlemen, any more questions from the floor? No? I think you have done your duty.
Cool.
Ambre, Soubiran, merci. Merci beaucoup. C'était vraiment super.
Merci beaucoup.
OK, de rien. Ladies and gentlemen, big thank you to the CEO of Kaiko,